Trader's Guide Part 1: Understand the market. This is not financial advice. Understanding asset classes. When you trade financial assets of one kind or another. There are different classes, or types, of assets, such as fixed income investments, that are grouped together based on their having a similar financial structure and because they are typically traded in the same financial markets and subject to the same rules and regulations. There's some argument about exactly how many different classes of assets there are, but many analysts commonly divide assets into the following 5 categories. Stocks, or equities. Equities are shares of ownership that are issued by publicly traded companies and traded on stock exchanges, such as the NYSE or Nasdaq. You can potentially profit from equities either through a rise in the share price or by receiving dividends. Bonds, or other fixed income investments, such as certificates of deposit (CDs). Fixed income investments are investments in securities that pay a fixed rate of return in the form of interest. While not all fixed income investments offer a specific guaranteed return, such investments are generally considered to be less risk than investing in equities or other asset classes. Cash or cash equivalents, such as money market funds. The primary advantage of cash or cash equivalent investments is their liquidity. Money held in the form of cash or cash equivalents can be quickly and easily accessed at any time. Real estate or other tangible assets. Real estate or other tangible assets are considered as an asset class that offers protection against inflation. The tangible nature of such assets also leads to them being considered as more of a real asset, as compared to assets that exist only in the form of financial instruments. Futures and other financial derivatives. This category includes futures contracts, the forex market, options, and an expanding array of financial derivatives. It's difficult to classify some assets. For example, suppose you're investing in stock market futures. Should those be classified with equities, since they're essentially an investment in the stock market, or with futures, since they're futures? Gold and silver are tangible assets, but are most frequently traded in the form of commodity futures or options, which are financial derivatives. If you invest in a real estate investment trust, REIT, should that be considered an investment in real estate or as an equity investment, since REITs are exchange-traded securities? Things are further complicated by the expansion in available investments. Exchange-traded funds, ETFs, for example, are traded like stocks on equity exchanges, but ETFs may be composed of investments from one or more of the 5 basic asset classes. An ETF that offers exposure to the gold market may be partly composed of investments in gold bullion and partly composed of stock shares of gold mining companies. There are additional asset classes, such as artwork, various other collectibles, and peer-to-peer lending. Hedge funds and other sources of venture capital, along with markets that trade things such as Bitcoin and other alternative currencies, represent some other asset classes that are a bit more off the beaten path. Generally speaking, the more an investment falls into the category of alternative investment, the less liquid and the more risky it tends to be. Good news. You don't really have to know for certain which asset class a specific investment falls under. You just need to understand the basic concept that there are broad, general categories of investments. That fact is primarily important because of the concept of diversification. Diversification is the idea that you can reduce the overall risk of your investment portfolio by investing in different types of investments, such as investments in different asset classes. There is usually little correlation between the different asset classes. In other words, during periods of time when equities are performing well, bonds, real estate, and commodities may not be performing well for investors. However, during bear markets in stocks, other assets, such as real estate or bonds, may be showing investors above average returns. You can hedge your investments in one asset class, reducing your risk exposure by simultaneously holding investments in other asset classes. The practice of reducing investment portfolio risk by diversifying your investments across different asset classes is referred to as asset allocation. The other reason to have a basic understanding of asset classes is just to help you recognize the nature of various investments that you may choose to trade. For example, you might choose to devote all, or nearly all, of your investment capital to trading futures or other financial derivatives, such as foreign currency exchange, forex. But if you do, you ought to at least be aware that you have chosen to trade a class of assets that is usually considered to carry significantly more risk than bonds or equities. The extent to which you choose to employ asset allocation as a means of diversification is going to be an individual decision that is guided by your personal investment goals and your risk tolerance. If you're very risk averse, have an extremely low risk tolerance, then you may just want to invest only in the relatively safe asset class of fixed income investments. Alternately, you may aim to further diversify within an asset class, such as by holding a selection of large cap, mid cap, and small cap stocks, or by investing in various industry sectors of the stock market. On the other hand, if you're blessed with a high risk tolerance and/or having money to burn, you may care very little about diversification, being more focused on trying to correctly identify the asset class that currently offers the highest potential profits.